Join one of Virginia's oldest and most experienced personal injury law firms as we explore how the law does and doesn't work, the art of leadership, and the power of community. Now, here are your hosts, Peter Burnett and Jonathan Slater.
Today, we're going to talk about one of my favorite subjects, which for most people is about as interesting as making funeral arrangements, and that is buying insurance. It is amazing how little most consumers of insurance really know about how it works. And there are really two major categories of insurance, maybe a third nowadays, called medical payments coverage, that I think has taken on considerably more importance with these unbelievably high deductibles that we see and copays. And I think in the car accident environment, medical payments coverage can help there. But I'll get into that later. The first point I want to make is when I ask folks if they've got, or ask them what level of insurance they have, they'll frequently say, "Oh, I don't know, but I've got full coverage." And then if we are able to go further and establish what the amount of their coverage is, the next statement is, "Well, I'm a good driver, and so I don't need to get high levels of coverage." And the unfortunate part about that thought process is that our practice in its entirety is folks who are good drivers. None of our clients were at fault for the accidents that we're representing them on. Almost every single time, there is no dispute about who was at fault. So, and there's a benefit to having insurance that covers you in a situation where the person that hit you doesn't have adequate coverage, and that's called underinsurance or uninsured coverage, and we can get into that later on. But I'm thinking about it more right now on the liability side, and it comes up in a number of different ways. The overarching rule, and John, you've seen this numerous times, of what I call the insurance love affair with the almighty dollar, and how much they like to hang on to their money. And one of the first things they do, you've had cases and I've had cases where first thing that the company does is a coverage analysis. What does that mean? They're looking to see if the insured was in full compliance with the insurance policy that they bought. And if they're not, they can deny coverage based on material misrepresentations or at the time of buying the coverage, or perhaps engaging in activities with the subject vehicle that are not covered. And I want to give a couple of examples of that because I think it's valuable information. Would you agree with me, John, that most people just don't understand the implications of having inadequate insurance?
I think that that's fair. Peter, I've worked with you for some time now, and it is safe to say that you are absolutely passionate about this subject, about insurance, and about making sure that that people are adequately insured. And as you alluded to earlier, I'd say that 8 out of 10 times that we have a client or prospective client come in, when we ask about their insurance coverage, what do they say? Fully covered.
Don't know. I'm fully covered. Don't know amount. I'm fully covered, though.
I'm fully covered. What does that mean?
Well, it means this. For one thing, it means that the insurance agent was successful in selling them every kind of insurance that they had to sell.
Exactly.
Collision coverage. And
do you think it's safe to say that the insurance company likes that response?
Oh, I think so.
Yeah, right.
I think they like that response.
Right.
I think they want to develop in a customer of the insurance company, just a blind trust that the insurance company knows more about all these things, and the insured is being taken care of by the insurance company agent. And that's an interesting point in and of itself. How many people refer to my agent, right, which just isn't so. The agent's principal is not the insured. The agent's principal is the insurance company. He or she is selling insurance on behalf of that insurance company and owes a duty of due care and due diligence to the insurance company, not the insured.
Right. Right. And it's just amazing and also unfortunate how many folks there are walking around out there with $25,000 in coverage, but they sleep well at night knowing that they're fully covered.
Right. And the insurance company likes it that way to kind of close the loop on that. You've got 125,000 car accidents in Virginia every year. About 70,000 claims come out of that 125,000 accidents. And of those 70,000 claims, 90% are settled or resolved for under $25,000. The average settlement in the United States, so the last time I checked that they were publishing them was about 2 years ago, $17,000. So what does that tell you? If you stop and think about it, that's where insurance companies make all their money, is on those case after case after case that are small, can be evaluated by computers, are probably not worth litigating for the claimant, and they can more or less have their way. They don't want to sell high levels of coverage. Now, commercial lines, different story. Tractor trailers and big companies and some of that. But on personal line insurance for personal use of an automobile, they're just not interested in selling high limits of coverage. I had a friend of mine check, he's an agent, check with, I believe it was 8 companies to see what their charges would be for single limit $1 million coverage. That is $1 million per person, $1 million per accident. And lo and behold, 7 out of the 8 companies he contacted did not sell single limit $1 million policy. Period.
Amazing.
Won't sell it to you.
Amazing.
Yeah.
Well, Peter, remember, we have a colleague who went to increase the amount of his coverage to what I believe was I can't remember how big of an increase it was, but
he
it was
went from 300, and he wanted to go to 500.
Go to 500. And what did they do? He sent in his request, and they responded with an email with about 15 different questions trying to get to the bottom of why he wanted to increase his coverage to that amount. What does that tell you?
Right. It was all about, are you doing this? Are you doing that? Et cetera, that, if you're not doing all these things, what the heck do you need all these high levels of coverage for? And our experience in representing hundreds and hundreds and hundreds of clients over the years has been that when you need it most, when you're most injured, that's when you got to have adequate coverage. And it can be, I call them double victims. It's just terrible when somebody gets super hurt and then there's not enough insurance money to take care of their injuries.
Yep. There's nothing worse than sitting across from somebody at this conference table who has very, very serious injuries. And it becomes quickly apparent that there might only be $25,000 in liability coverage to cover what would otherwise be a potential recovery of who knows
6 figures.
Six figures.
Yeah.
But that's why we're so passionate about this stuff.
Right. And so let me give you an example or two. I'll give you one example of how it can kind of sneak up on you, and give you another example of how a friend of mine, just consciously taking his chances. So the first one, interestingly, is a nurse consultant who came out here to interview with us about doing some work for us here at the firm as a nurse consultant. And we got to talking, and it turns out she's an empty nester. She's divorced. She lives by herself in her own house in Fairfax County. And I asked her about her insurance coverage. And I said, do you have business insurance coverage? for what you're doing right now? And she said, what do you mean? And I said, well, you're engaging in a business practice. You're trying to generate business by coming out here and meeting with me. If you had been in a car accident on your way out here or when you leave here, and your insurance company were to learn that this trip was a business-related trip and that the automobile was being used for business purposes, and you had not disclosed that to the insurance company, many an insurance company would decline coverage. They'd say, sorry, you didn't tell us that you were using this vehicle for business purposes, and so no coverage. Well, and in many, many, many cases, when there is no insurance coverage, lawyers in our shoes and other lawyers and even claimants who are trying to do it on their own will just walk away because most folks don't have any money to speak of. And if they do, they're going to take that money and use it to discharge their obligation in bankruptcy. Spend $1,500 or $2,000 and make that damages judgment go away. Well, what if you just happen to be single and you're 60-some years old, and you've worked hard most of your life, and you've got a house, and it's pretty close to paid off, and it's worth, say, $600,000 or $700,000, and maybe you owe $100,000 or $200,000 on it, but there's $500,000 equity in that property that you own, and
exposed.
It's exposed. That's a great way of putting it. You know, that's part of our due diligence when we look at these cases, is to see, and I'll be the first to admit that these are rare birds, that somebody's got exposed assets of any significance.
Yep. And you used an important word. You did say single. That's not to say that married people shouldn't have similar concerns, but single in that context is very important.
Well, that's where the exposure comes from. Mm-hmm. In Virginia, I can't speak for other states, but in Virginia, marital property cannot be used to satisfy a judgment against one of the marital partners. So to state it simply, if the wife's in a car accident and gets a big old judgment against her over and above the insurance amount, the house that husband and wife own together as marital property can't be used to satisfy that judgment. And so that's one of the things that I think is particularly important, and the reason I give my insurance talk to financial advisors, because they don't typically think about this. They think about life insurance. They think, I guess, at some levels about burial insurance and the like. But drivers 65 years and older are the second most likely demographic group to get in an accident. The number one is first-year drivers, 15 and 16-year-olds. But after that, it's 65 and up. And you get folks who are married, their reflexes are a little slower, their vision's a little bit blurred maybe, their hearing's not quite as good, their neck is stiff and they don't turn around quite as quickly and as easily as they did, they're maybe not quite as observant. Maybe they even have kids that are telling them, Dad, you got to stop driving. And most folks don't like giving up that independence, so many folks drive longer than they should. But as long as it's husband and wife that's with us and they own that house together and one gets in an accident, if they have inadequate insurance, at least they're not going to lose the house. But what happens when spouse dies? It doesn't matter whether it's husband or wife. All that grief and all those things going on with that transition from a partner for life is not the first thing you're thinking.
Not the first thing you're thinking about.
No, you're not thinking about, I think I'll call my insurance agent to make sure I've got adequate auto insurance. Mm-hmm. They're not thinking about that. And they go about their business. And, I had a lawyer friend of mine come see me, I guess 6 months or a year ago. He'd been in a minor accident. He's retired. And he said when he went and looked to see what he had for coverage, because, of course, he didn't know. He just knew he was fully covered. He was shocked to learn that they hadn't really increased his coverage for 10, 15 years. They're waiting for him to ask. Well, they're not going to do it unless you ask, and because they like low levels of coverage. But it was a ridiculously low level for him, and he got himself a little bit of lesson by sitting down and talking to us about it. So that's one exposure that you can do something about pretty easily. And I should say $100,000 worth of coverage costs $500, then $200,000 worth of coverage is going to cost $1,000. It doesn't work that way. It's based on risk. And what I said earlier, most claims are under $25,000 in terms of what they cost to resolve. So most of your premium dollar goes towards that first $25,000 worth of coverage. And it's the higher level coverages, which are very important if you are injured significantly or you injure somebody else significantly, that are not that expensive. I moved my coverage from $500,000. That's called $500,000 single limit per person per accident, same amount of money, same limit. To $1 million per person, $1 million per accident, and I had 2 teenage drivers in my household, my 2 daughters at the time, and my insurance cost went up $40 per vehicle per year. So, and why is that? Because there are so few claims at that level of $1 million. I think we've had about 5 verdicts in Loudoun County of $1 million or more. I'm proud to say I've got a couple of them, as you know. And you just don't see those big verdicts. The cool thing is, for the cost of taking a friend to lunch, you can buy yourself coverage that's really going to take care of you if you're the unlucky one, if the fickle finger of fate lands on you. There are 14 car accidents a day in Loudoun County. There are 42 or 44 car accidents a day in Fairfax County. That's a lot of accidents. And you just don't know if and when it's going to be your turn. So buying that coverage, I think, lets people sleep well. I'll give you another example. A friend of mine is single. He has a successful contracting business. He employs 3 or 4 guys, 5 guys maybe, from West Virginia. And he provides them with a vehicle to go to and from work and to drive to, and he also has vans that are driven to the work sites, which these guys drive. And I asked him what he had for coverage, and he said, "Oh, I got basically the minimum." And that concerns me greatly, because here's an individual that's at the end of his career. He just built a beautiful new house that's worth about $600,000 or $700,000, and it's fully paid for. And there he sits exposed. If one of his employees gets in a bad accident, God forbid, and these are responsible guys that have worked for him for a long time, but that doesn't mean they can't make a mistake.
Right.
Any good lawyer is going to be looking at that house as a way to satisfy getting adequate compensation for an injured client.
And that's especially risky because he need not be concerned only about himself and himself getting into an accident. But there's three or all he needs to worry about all of his employees too. So it's the driving behavior of not just himself, but 3 other individuals as well. And
what about when the driving is taking place? Beginning of the workday and end of the workday. Those are the high end likelihood of problems.
Right. And Peter, it might be helpful just to briefly talk about respondeat superior and exactly what that means.
Yeah, the respondeat superior is a fancy lawyer's term for essentially the employer being responsible for the employee's conduct in the course of the employer and employee's business.
Right.
Doesn't necessarily cover frolics off into away from the work and the like, but when someone is doing the bidding, if you will, or engaging in the business of his or her employer, and that person negligently hurts somebody, then that employer is responsible for the injuries caused by the employee.
Right.
And that's what commercial policies are about. The purpose of these commercial policies is to contemplate all the different ways that an individual in business can be exposed to liability and make sure that there's going to be insurance coverage there if that unwanted and unfortunate accident should happen.
Mm-hmm.
But let me jump into one other area of coverage that I used to not give it a lot of thought about it, and it's called medical payments coverage. It's a creature of state law, and it is different in Virginia than it is in some other states. And it's different in this way. The medical payments coverage in Virginia is required to be offered by insurance agents to the insured, to their customers, in the amount of $2,000 coverage per year. And the coverage pays without regard to who's at fault in the accident, and it pays without regard to whether there's any other insurance coverage out there, which is where it gets a little different than some of these others. So to be clear, if I have medical payments coverage and the accident's my fault and I get hurt in the accident, you have to be in the vehicle, you have to be an occupant of the vehicle, and I get hurt, I can get up to $2,000 toward my medical bills from my medical payments coverage. Likewise, if John, you, and Lenny, and I are all riding in the car and we get in the accident and all three of us get hurt, there's $2,000 worth of coverage for each of us. And that coverage pays the usual and reasonable customary medical bills for a period of 3 years following the accident for accident injury treatment. And it gets better. Many, many families these days have more than one car. Some have 3 or 4 cars. That coverage in Virginia can be stacked by up to 4 cars in the family. So if you were to buy, and you don't have to buy $2,000 worth of coverage. You can buy $5,000 worth of coverage. You can buy $10,000 worth of coverage. I've seen some policies of $100,000 coverage. But if you have whatever you have for coverage, you can stack it. So if you had $5,000 worth of coverage and 4 cars, now you've got $20,000 available from the first dollar. Unlike health insurance, it pays right out of the box. No co-pays, no deductibles. Now it will want to pay usual, customary, and reasonable, which means discounting the same way insurance companies do that bill from the medical care provider. But that usually works out. And the reason that I'm much more keen on people buying medical payments coverage nowadays than I was 10 years ago is that it's not the least bit unusual for health insurance policies these days to have a $5,000 out-of-pocket limit, or sometimes a little less, sometimes a little bit more. So this medical payment coverage can become a real stopgap. It can really fill in that blank, and it doesn't have to be used for the medical. We've had cases where somebody missed time from work and they can't really prove exactly what their hourly rate is, and there's all kinds of difficulties with it. But they made ends meet because their insurance covered most of their bills, and they were good with that and had a good policy. Then they submitted again. It's double dipping, no question about it, but everybody knows it, and the actuarial rates are set with that in mind. And they collected their med pay. Now they had that money to use for other purposes. So I think it's a really valuable coverage.
I would agree. I'd say that most clients that we represent, Peter, you think it's fair that they have medical expense payments coverage?
It's pretty routine, and I think it's one of those situations where the client says to the agent, give me what the other guy's got. Just give me what everybody else has. And what they don't really appreciate is, the agent likes selling that med pay because they can make a little bit of money on that as the agent can. But they also don't realize that the agent's going to give you what the other guy's got, which is minimal or low-level coverages. And
usually between $2,000 and $5,000.
Typically, that's what you see with MedPay. Yeah.
Although I've seen it as high as $100,000.
It's remarkable. I don't know why somebody would buy all that much, because it really isn't that great of a deal when you figure you got to be in a car accident before you can collect on it. But the other states have what is called PIP, personal injury protection, and people have heard of that. And that is the coverage that you buy is to take care of any out-of-pockets you have after your own insurance company, your health insurance company, has paid. So, of course, it costs a little bit less money, but there is no double dipping to it. It by design, it eliminates the double dipping piece.
I say this without any evidence to back it up, but it would not shock me if more than half of the people that are at fault in an accident but have medical expense coverage probably never take advantage of it.
Well, I don't know what that number is, but look, how often, you tell me, how often when somebody comes in and we're having our initial interview and one of us or whoever's here says, well, tell me about your insurance coverage, prospective client. Mm-hmm. And sometimes you'll get the reaction, well, what are you asking me about my coverage? It wasn't my fault. Why is my coverage involved?
Right.
Well, it can be for a number of reasons. And some things as important as underinsured and uninsured motorist coverage. But at the very minimum, you've been paying a premium every year or every 6 months, however you pay it, for this MedPay coverage. And if you're not going to take advantage of it when you got hurt and get it to pay, give the money to your church, et cetera. But being knowledgeable about buying coverage is really a big deal for people to sleep well at night, to fully understand how to protect themselves against routine risks. And the really neat thing about it all is it's not that expensive.
And Peter, you give a really good talk on this subject, don't you? You should plug it really quick.
Yes, I do. And we call it fully covered versus full coverage. And it's 25 or 30 slides. And I go through this in some detail over the course of about a half an hour. And I give it to charitable groups. I did the Hamilton Ruritans about 2 weeks ago. I've done financial advisors, insurance agents. There are some things that insurance agents who are selling coverage don't know about the provisions of their coverage when someone makes a claim, and they often get their eyes open. So let me just make a really bare pitch here. If anybody listening to this knows anybody that would like to hear our insurance presentation, it's free, it's fun, and most people come away saying, I changed my coverage and I'm glad I did, and it didn't cost me much.
And one more thing, I want to make sure that we mention this. We don't sell insurance. We don't benefit from this in any way other than the sense of feeling good that we get from informing the public.
Well, or to state it a little bit different way, it's my doing this is really a reaction to how poorly I feel for clients and how really poorly the clients feel, that I call double victims, who have been in a terrible car accident, hit by somebody with no insurance or very little insurance. They've got a substantial claim, and gee, guess what? They don't have a decent coverage either. And a lot of them will say, well, somebody's got to pay. No. Our law in this state and virtually every state in the United States is perfectly happy to let you get the minimum amount of coverage if that's all that's there, and too bad for you that you didn't buy more. So I'm highly motivated because we see so many policy limit cases because, people are watching their pennies. They're being careful, and that's as it should be. They're prudent, but make those prudence decisions with full knowledge of the risks that you're covering and not covering. And I think everybody will sleep better.
Thank you for listening to Law and Community, a podcast from Burnett and Williams. If you have any questions or wish to learn more, please leave us a message at our website, www.burnettwilliams.com. Also, please don't forget to subscribe to the show on whatever platform you're listening to. Don't forget to follow our Facebook page at www.facebook.com/Burnett Williams and give us a call at 703-777-1650 for any questions you have. Hope you enjoyed the episode. Until next time, take care.